Owen, we're recording this on a Tuesday, so I thought let's do some pub trivia. You specifically wanted to talk about income today, so it's dividend pub trivia. Question 1 for you. These are going to be rapid fire, okay? Mm-hmm. Calculate dividend yield.
Last 12 months divided by share price.
Good boy. What is a dividend aristocrat?
In Australia or globally?
Globally.
50 years dividends?
25.
25, yeah. Right.
Name an ASX listed dividend aristocrat.
Soul Patts.
Ba-bow.
Ramsay Healthcare.
Ba-bow.
There's someone.
It's a false trick question. There aren't any.
But isn't one of them's not far away? One of them was only like a year or so ago. Was only
rapid fire, Owen.
Okay, go.
Who am I? Listed in 1903. I've paid a dividend every. Yes, since 2000. So. Listed in 1903, I've paid a dividend every year since I was listed. Since 2000, I have increased my dividend per share every year. So therefore, it's on the verge.
That's the one I was thinking of.
It's on the verge of becoming our only dividend aristocrat.
Macquarie's had over 50 years of profit increases, but I don't think it hasn't.
Profit aristocrat then. Right, just stop hijacking the trivia, Owen. You buy a stock on the ex-dividend date. Do you receive the dividend?
No.
Correct. What is the difference between bonus shares and dividend reinvestment plans?
Bonus shares are just given to you by the company, whereas DRP, you have to reinvest your dividends.
Sorry, I should have. This is an issue with the Trivia Master. When I'm talking about bonus shares here, I'm referring to there are some ASX companies where you can, instead of having a DRP, opt for bonus shares over the dividend.
Oh,
Have you seen that before?
Who does that?
Namely the banks. A lot of some older companies like AFIC, for example. Do you
mean like a DSSP?
No, not like a DSSP. These are actually BSPs, bonus share plans.
Oh, no, I've never seen them.
So a bonus share plan, it is non-tax. You're not taxed on the bonus share like you are taxed on a dividend when you receive it, and it goes to reducing your original cost base.
Sounds like a DSSP.
It's a BSP. And you're not going to get this next question, right?
Okay, go.
Name a company other than the banks and AFIC that offer a bonus share plan. You won't get this right because you didn't know what one was.
No.
This company surprised me when I was looking it up. No, ArbCorp.
Really?
Yeah. ArbCorp has a BSP.
The 4x4 accessories business.
4x4 accessories. That's right. What's the follow-on question? What's the yield on ArbCorp?
I was just about to look it up on the computer. I would say 1.5%.
Incorrect. 2.3.
Really? It's a buy.
Financial advice right there. In 2020, all of the big four banks cut their dividends. Obviously, we had COVID. Which two have returned their dividend payment amounts to pre-COVID levels?
Are we including Macquarie?
No, the big four.
Oh, sorry. CBA and NAB.
Yeah, 50% correct there.
CBA was one. Oh, well, yeah, because NAB, they did actually have to do the forced convertible notes. Westpac.
Oh.
So it's ANZ. Oh, Jesus. Super regional blow up.
What percentage of earnings on average does the ASX 200 pay out? The average payout ratio.
I'm thinking franking credits. I'm going to say, because are we talking weighted? So that cause it's like ASX 200, market cap?
Market cap weighted.
I would say 65%.
Absolutely nailed it.
Oh, really?
Yeah, bang on.
Okay, a bit of pub trivia back to the master. What is the typical rate of franking across all dividends paid on the ASX 200?
It's about 70%, isn't it?
Yeah, well done. We haven't prepared these in advance. That's good.
What is the yield on VHY?
Time recording 5.2.
6 according to CommSec. I was just on CommSec before. I had a look.
Okay.
We're about to talk about this ETF as well. What's the yield according to CommSec on YMAX?
According to CommSec, I mean, you could get bloody anything out of that thing. 7%?
8.1 apparently.
Yeah, because Rob and Peter to pay Paul.
Radio.
So wait, here's the equity yield. Can we please bring this up here, Adrian? This is the equity yield for people that are listening. So when you see in your brokerage account the historical yield, it includes a bunch of mumbo jumbo, which we can talk about. But the actual underlying yield of VHY is 5.08. Not bad.
So you're trying to say you were pretty much right?
I was pretty much right.
Okay. You did pretty well there. I did not give you any of these questions beforehand, so I think you did pretty well. So along that income theme, what I want to talk about for this next little section is just comparing and contrasting a couple of ETFs. So if people go to an ETF scanner or a filter and they look up income or dividend, etc. ETFs, they might be met with these four options. Mm-hmm. So the first one, and we should know this one pretty well, is the Vanguard Australian Shares High Yield ETF, VHY. Mm-hmm. The second is what we just discussed, which is YMAX. So YMAX is the Beta Shares Oz Top 20 Equity Yield Max Fund. So, and then the third ETF I want to talk about is the SPDR MSCI Australia Select High Dividend Yield Fund. And then finally, another Beta Shares one, the Australian Dividend Harvester Fund. So take these as you like. I thought they were good, 4 good ETFs to kind of break down, talking about income to see how they go about achieving the yields that they do for their investors.
Okay. VHY is the one that we hold for disclosure. So VHY basically just scans the ASX but uses forecast dividends. It uses like analyst ratings to get the forecasts and then weights them accordingly. So you end up with a similar structure to the overall stock market index because you'll get like CBAs and stuff like that. They're going to pay dividends. But because it uses forward-looking dividends, you get a protection. Some of those old ETFs, in fact, most of the old dividend ETFs when they came out like 10 years ago just used historical yields, which is what a lot of the brokers show. Most people probably are aware of this now, but your stockbroker, if it shows dividend yield or yield on an ETF, it's using backwards looking data. And in particular for ETFs, it's totally wrong. So that's what that does. SYI was actually, when I last looked at all the numbers and when we were setting up our portfolios, SYI was probably in the top 3. There's one from GlobalX, which is a sponsor of the show for disclosure. The GlobalX one was recently modified. So the good thing about VHY is from Vanguard is that it's got 60 to 70 stocks. I think I just had it up. It's like 67 or something. And it always has good diversification. But SYI has a little bit less. And if you keep going, the GlobalX one was also about 40 to 50 from the top of my head. You keep going down into some of the other dividend ETFs and they get narrower and narrower and narrower, which is totally fine. But if you want the diversification, because most retirees that would use VHY or one of these ETFs, like predominantly retirees use them, they want stability in income, not just income, because the reason that they use these is because they prefer the current income, not the long-term gains. And so if you have a really narrow one, you have to combine it with something else and it just adds a headache. Vanguard actually just came out with a defined income type product actually, which is really interesting. If we move on, you've got ETFs like YMAX, which I've just got here in front of me. So YMAX, I think, is the buy right / covered call strategy from the top of my head. Yes, we don't use any of these strategies we don't use any of these funds in our strategies. A lot of these ETFs, Mitch, as you know, what they try and purport to do is to maximize income in like the next 90 days, 6 months, 12 months, whatever. Because it's maybe shame is a bit of a strong word, but it's an unfortunate reality that most people that are new to investing go for really simplistic ways to invest. They're like, well, I'll just go and buy the thing that has the next dividend or the next this, thinking that no one else had ever thought of that. There's a crude old quip, which is every generation thinks they invented sex. And I think every decade of investor thinks they invented investing. And these, like those types of strategies work. I'll come back to YMAX, but Harvester is very simple. It just buys the next dividend. And a lot of these strategies can work because you get franking credits in Australia. So over time, they can do something useful for you. If you're an accumulator, a lot of these strategies don't make a lot of sense. There might be markets, like for example, during moments of volatility, dividend style companies tend to perform better than non-dividend style companies because, like in COVID, for example, not immediately after COVID, but once inflation started and whatever, people tend to gravitate to blue chip shares because they're more likely to survive. And so they tend to exhibit moments of outperformance.
Well, we saw that during the Trump slump as well. You've seen shares like Telstra, Woolworths, Coles actually rally.
Yeah. Yeah. Well, what else are going to, money has to go somewhere, right? So they either go to, well, when they don't go to US treasuries, they go to like Staples and stuff like that. So that's that. YMAX is the anomaly of all of them really, because it's the only one that does something quite exotic.
And it's, if you do look it up, it is slapped with the term complex
in the title.
At the end of the title.
So it's Australian Top 20 Equities Yield Maximizer Complex ETF. So this was a naming convention brought in by the ASX. And basically the nomenclature, if you will, Mitch, is that anything that has complex in the title is effectively telling you that it does something that's kind of adding leverage or synthetic style exposure. So meaning like derivatives and that sort of stuff, just so you're aware. And also the naming convention around ETF in Australia got a lot more stringent. And so what this does is you effectively buy some shares and then you can write options over the top. So basically an option is like a finance contract, but when you sell one of these options or you write it, that's another word for it, what actually happens is you receive a very, very small amount of income for whoever buys that finance contract or takes you up on it. And over time, that can slowly increase in value until a point where you get some sort of, it kind of goes null and void, and then the contract can then roll again and again and again. And so effectively you get what we call premium income. Now, if I've lost you a bit, basically it means that if you don't understand that, you probably shouldn't invest in this in the first place. Second of all, that you don't necessarily need these types of things. There are brilliant ETFs out there that offer different types of exposure. One thing that people probably aren't aware when they build portfolios is that there are different ETFs for different market cycles. And this is probably an ETF that's suited to a particular type of market cycle. In the finance game, if you walk up and down Collins Street, they might say something like this: in a sideways market, you own an ETF like this, because even if the stocks aren't going up, at least you're getting the income from the derivatives. So you can earn a little bit extra income. But that's basically the extent of it. And I think a lot of it's got $540 million invested in it. BetaShares sponsors our Australian Finance podcast for disclosure.
This was one, I remember when this came to market, it was one of the really, really early, more exotic income ETFs, and it did attract a lot of attention early on. So I'd say a lot of that money that's probably flowed in there has stayed in there. Yeah.
Can you bring it up for us, Adrian?
And I think it's important, Owen, to go back to one of your comments during our brief trivia run. You were talking about robbing Peter to pay Paul.
Yeah. Yeah. So some ETFs that target...
I was guessing that this was maybe the one that you were referring to.
So some ETFs, it kind of does it a little bit. It's not too bad. But some ETFs, if you think of dividend investing as a seesaw, on one side of the seesaw you have growth, and on the other side you have income. In the middle you have total return, which for most people, if you're investing in a reasonable market, just round it out to like 8, 9, 10%, right? If you put 6 on one side, you've only got 4 on the other. If you put 5 on that side, you got 5 on that side, 1 on that side, 9 on the other. People think that for some reason that by doing one or the other, it's going to be so much better. Good investing is not that. Good investing is targeting the total return, which is the thing in the middle. It's like trying to get that bigger. So like this thing is a good ETF, don't get me wrong. And it's probably it's the best of what it does in the country, but it's not necessarily everything for everyone. One of the things that's interesting here is you can see this gross distribution yield on the fund of 8%. That's because you're not just getting the income, you're also getting the options premium. But remember, one of the things, this is probably a salient point I should have mentioned at the top, Mitch, is that a lot of financial things like ETFs and funds are made for retirees. And what I mean by that, they assume
you can use the franking credits to the fullest extent.
Yes. And there's no tax to pay. So inside of the ETF
portfolio turnover, et cetera, is negligible to you.
So if you and I went and had an options contract and we made $50 on it, we would pay tax on the $50. But in a retiree environment, you don't pay tax. So these types of strategies are good for retirees. They might be good at a certain time for a certain type of investor, but maybe not for us. Another time that these can be good, just quickly, I don't want to spend too long on the covered call strategy, but another time that these can make a lot of sense is when volatility is very high because the options contracts are worth more. Volatility increases the price of options contracts. I'll leave it there. I don't want to go too far.
I just want to ask a quick question then. VHY is one of the more simple income ETFs out there, equity income ETFs out there. Why did you choose that particular one to go into the Rask Invest portfolios?
Because it's got the most diversification, basically. Yeah.
And it's quite comparatively speaking as well. It's quite a low MER as well.
Yeah, low fee. Yeah, for sure.
All right. We've just spoken about the construction of income generating ETFs. I want you to put your product issuer hat on.
Oh, yeah, this one. Yep.
And I'd love to hear what your criteria would be. So, for example, you're building an equity income ETF. What are the rules in the Owen income strategy?
Yeah, I think I took this because you sent me this one in advance. And
I think it's a bit of a rough one to put you on the spot.
I think I stuffed this up. I actually like these games for what it's worth. I actually stuffed this one up because the way I interpreted it was what's the best total return.
Don't have to tell everyone that.
No, so
they haven't heard you.
Okay, so a lot of my answer to this will loop back to where we ended there with VHY. A big problem that ETF providers are going to have in Australia, maybe AI can help with this, and the index providers, like the people that like the Miskies and that, is that because there's not going to be as many active investors in the next 5 or 10 years. We know that for sure. You can see it. It's already happened. What's going to happen is there's not going to be as much broker research, not as many forecasts of financials and that sort of stuff. So the actual ETFs trying to figure out which dividend stocks to buy
that rely on that broker forecast, and that may be a consensus view of that broker forecast.
Exactly.
If your pool falls from 20 to 3 or 20 to 5 or whatnot in the long run, what's the value of that consensus data?
Yeah, so if we can maybe bring up the screen again, and this, for people that are listening, I've brought up the ticker terminal, TIKR, great little tool that you can use, kind of like the poor man's version of Bloomberg. Like the very poor man's version, let's be honest. Good tool though. Let's not shame it, seeing that we use it.
Look, if you're listening, Ticker, I'd love for you to sponsor the show after that glowing endorsement.
I use Ticker more than I use any other financial tool.
If you want to get also call transcripts and things like that are awesome. Usually only available to analysts and whatnot.
Yeah.
That's what I think that is a great thing that Ticker offers. And it's not like it's Australian, ASX listed, global. US, global, etc. So you can get call transcripts for anything. So you can hear directly from management. So that's me trying to save the relationship there, Ticker, if you would like to sponsor the show.
Yeah. So here, you can see we've brought up CBA's forecast. So like Ticker pulls in all of the forecasts for dividends per share. And if we go 1 year ahead, you can see there are 12 estimates. The year in front of that, 12, 11, 4. So no one really goes to 4 years. 5 years, there's one estimate out to 5 years into the future, right? So that's the biggest company in the country. Back when I started my career, there would have been at least 30. Let's go to like something like, we might even talk about this, is AP Edgar's like a ticker symbol is APE. It's Eagers Automotive, is that what we call it these days?
Yeah, Eagers.
Yeah. This is like a mid-cap in Australia, I guess. Good business. So here we go. We've got dividends, 74 cents. Let's go forward 1 year. 15 estimates, 14, 15. Jesus, it's got a lot. Where are they? 3.
More than CBA.
2. So it's more than CBA. How big is this company? Anyway, this is not proving my point.
An excellent point.
So it's $4 billion.
Perhaps people have jumped on the wagon because it's been an exceptional performer of late.
Yeah, but my point is that number, even for CBA, is coming down. Thanks, Adrian. So people that design these things are going to rely on probably AI. It's probably going to be a better forecaster anyway. But that actually presents a roadblock for people that want to DIY something, or even ETF providers. So how would I do it, Mitch? I think I've never made one myself. So all the ETF providers that listen to the show, and there are a couple, will probably be like, that's not how it works. But my understanding, I just want to
understand your rules,
is I would use the cash flow statement, not the profit and loss. So most of the ETFs in Australia that do something other than index funds use like the price earnings ratios, the dividend yield, all of these things, the revenue type stuff. A lot of that stuff can be found on the income statement. Some of them will use debt, like the quality ETFs. They go low debt levels, so that's on their balance sheet. I don't know of many or any that use the cash flow statement.
I'm pretty certain last year, BetaShares
Cash Flow Kings?
Cash Flow Kings.
Was that interesting?
That was last year.
So let me just bring this up because I just want to, Cash Flow Kings ETF. Here we go, Mitch. So this is the Global Cash Flow Kings ETF with strong free cash flow. I do remember this coming out.
Yeah, I couldn't remember if it was Australian or global, but
it's global. But one of the things that happens with these, it's got NVIDIA in it. There you go. I don't know the actual underlying constructs of this, but what I would say is, without knowing exactly, a lot of the index, when we calculate free cash flow as an industry, which is what it's using, we use the income statement method for a lot of it. I could be wrong about this, but what my point is that we should be using the cash flow statement more often, particularly in Australia, to find companies, at least if you're using like a screening tool. And the reason is that a lot of small, mid, even large companies in Australia play a lot of shenanigans with the reporting. So if I was designing one, I would want to know what's the cash flow growth rate, so like cash receipts. And then if you want to get fancy, you could do operating cash flows minus investing cash flows. So without going too deep in this, it's effectively saying, what is the actual cash that's landed in your bank account this financial year, minus what you pay your staff and for your business premises and all that, minus what you've invested for the future. So that's the truest definition of free cash flow is I'm investing for the future and I've covered my bills. But most of them don't do that. I think you'd be left with a very limited pool. But if you think about the essence of dividends come because a company is able to pay the bill first, but you don't want the company to be paying the bill and not investing for the future, which is that second element, which I talked about. So if I was a long-term investor, which I am, and I wanted a dividend ETF, I'm happy to forgo a little bit of income now in order to make sure, absolutely sure, that income stream is going to be sustainable and the companies will grow.
So you're looking for quality, value, and a growing sustainable dividend into the future.
Like ARB you mentioned before, you said it was like 2% dividend yield. That's got to be one of the best dividend stocks in Australia ever. And that's like a 2% dividend yield. And if we go back to the seesaw analogy, you can have virtually unlimited growth from a company, like in profit from here to 10 years, but you're not going to have unlimited dividends without unlimited profit. So choose the profit first. Choose the thing that's growing because that will protect you more than a dividend trap.
So focus on those key inputs rather than the output. And
I'd be really interested to do this actually because we can actually do this, and you can use Ticker to do it. What a great tool Ticker is. You can
potential sponsor of the show.
You could run a screen of all ASX companies with their net cash flows and then run it with like some other metric, right? Like profit or dividend payments, and then determine against the share price which one was more indicative of the long-term return that you would get. No one's going to make my product because I'm probably the only one that would geek out on it enough. That's why things like Harvester exist, because they're really simple and easy to understand. VHY is really simple, easy to understand, and they're all like good products.
Your methodology reminds me much more of a couple of actively managed income products that we know out there. I mean, for example, you interviewed, I'm going to forget his name, from Merlin Capital.
Oh, yeah, Andrew. Is it Andrew?
Andrew. Yeah. Sounded very, relatively similar but looking for undervalued catalyst to unlock that value, but also growing streams of earnings to be able to pay those future dividends. So the yield, the dividend yield, even though it's an income fund, the dividend yield does not come into the stock selection factor.
Yeah,
essentially straight up.
Yeah, so dividends are an output, not an input, I reckon, to these types of things.
So did you only give us one selection criteria?
So what I do...
Or your ETF? We have to round out your ETF.
So what I would do, there's effectively 2 criteria and then there's like a third safety net. So the first criteria is over 3 years, I want the cash receipts to be growing. So it has to be positive. Cash receipts are the cash flow equivalent of revenue. So revenue could be like, yeah, I'm going to do this thing in the future. I'm pretty certain of it. Give me that revenue, and they can manipulate it. But with cash flow, it's actually what's in the bank account. So cash receipts growing over 3 years. Second metric is the cash from operations minus the investing cash flows. So this is like a little bit more technical. It's that after my expenses, I've paid in cash after I've invested for future growth. That has to be positive for at least 2 years. And then finally, companies over 200 mil market cap. And that's just because, that's pretty limiting. But you don't want to spec. There's a very long tail.
You wouldn't want to buy them in an ETF.
Yeah, we were looking at the ATEC ETF for the investment committee this week. I think the smallest company inside that was 130 mil market cap.
Surprised by that.
But they only own like 200,000 shares or something. Yeah, so it's bugger all.
Okay, so moving on, there's a couple of questions that I just want to cover off. These are questions we've fielded directly from community members and one that just popped up into the community. So I thought I'd ask these of you. So this is a not too uncommon question. I'm a retiree and I just want to take a 5% income from my portfolio. How can I achieve this? How can you help me actually achieve this desire of 5%?
5% with franking credits or 5% franking credits on top? You want a bit of is that the cherry on top? Or is the cherry part of it?
Ooh. Give it to them on top.
Okay. So going back to our seesaw analogy, if you just had all income on one side, you're not going to get any growth. You might get 5% this year, but you're just going to annihilate your future returns. And if you go all the way the other side, you're not going to meet current cash flow needs. So I feel like I'm saying this a lot, but it's not sponsored anyway. PIMCO, who's appeared on the show, a retirement podcast recently, they have, can we bring this up, Adrian? The PIMCO Global Credit Active ETF, relatively recent ETF edition, but these sorts of things are starting to appear in Australia, which is great. And this is a actively managed bond fund. And I wanted to bring this up because it's probably the best example of this now on the stock market. It's existed for years. But if you look at the yield to maturity on this, which I consider to be a defensive investment for people that are watching, it says 5.38% estimated yield to maturity. So that would be if you held all the bonds inside the ETF until they matured. I don't know if that's before or after fees, but you get the idea. Thanks, Adrian.
The fee, I just saw that, is 0.61.
0.61. Like I said, sponsor of our retirement podcast, not paid to say this, but so the reason why I bring up the global credit fund is kind of a credit fund is kind of in the middle of the seesaw. Whereas a traditional cash investment like term deposit or a AAA or SEC from iShares. That's on the pure defensive side of the seesaw. And then on the other side, you've got like VHY and income-focused ETFs. Riskier, but they're going to get you income, right? So just think about it like that. Think about this seesaw, and we want the seesaw to balance at 5% or more. If we've got things like that are credit, which is like not that risky, but still a little bit risky, but good bond fund manager in the middle, things like AAA from BetaShares, ISEC, and MMKT from BetaShares, which are standout cash-like ETFs, so they're lower risk, they're paying anywhere between 4.1 and 4.5%. So we're almost at 5 without taking that much risk. Term deposits over a 3 or 4 or 5 year maturity are probably paying something similar. And then on the other end, you've got the VHY paying 5.1 plus franking credits. VAS or A200 or STW, IOZ, MVW from VanEck, all those traditional Australian shares ones are in there. They're probably about 4% with franking credits, give or take. So you don't have to go out and run a marathon to achieve this pretty good hurdle rate of 5%. Where you will be brought down is you will need global shares exposure. So you could do that through IOO from iShares, VGS from Vanguard, BGBL from BetaShares, or IVV from iShares, even things like FANG, whatever. You're only going to get 1.5 if you're lucky.
Yeah, the IVV from iShares is 1.5%.
There you go. So they will make it up in growth. So you could trim that position at the end of the year, which, by the way, for many people is probably more tax effective. Sell it after you've held it for 1 year and just trim a little bit. So you can effectively compile all those together. If we throw in something else that we might talk about, which is the Charter Hall Long Whale REIT, CLW, which is a property exposure, more risky than a lot of the stuff that we're going to talk about today because it's a single real estate investment trust. I think if we bring that up, I thought I had it here. I don't. Thanks, Adrian. CLW, market index numbers, dividend yield 6.6%. That'd be unfranked because it's a property trust. But over time, reasonably reliable. Watch it bloody blow up on me now that I said that. But reasonably reliable. You could use something like BWP Trust, which owns the Bunnings Warehouse properties, some of them. You could splash a little bit in there to kind of make up for the lack of income from something like IVV or whatever. Again, it would be a mistake to not include US simply because your target is 5%, Mitch. You would include it and then sell a little bit when it's overweight anyway. Yes, there's going to be a little bit of cost involved, but you will get the long-term growth that will support the 5% income for years to come. There was actually something interesting here, Mitch. If we can keep this up for a second, Adrian, I wanted to show you. So I hadn't been on the SPDR, that's SPDR website, for at least 40 years. I don't know if many people go on here besides financial advisors, to be honest with you. No offense, Spider. Maybe a bit of offense.
They'd be sitting in the office going, guys, someone's on the side. Guys, we've got a click.
We're done.
The sponsored ads are working.
So if we look on the screen in front of us, so this is an ETF that focuses on the dividends, which we talked about. It's got a quality overlay that no one knows what that does, but nearly 5% on this ETF. What was interesting when I looked at this is you can actually see the makeup of a dividend ETF by looking at this, because you can see, and if I bring up, let's see if I can, what's the other fund? It's STW, isn't it? That's the one.
Yeah, that's the ASX.
Okay, so if we put ASX 200 ETF from the STW, which is a good ETF from
that's a low MER.
Like 0.05% on this fund. So dividend yield on the ASX 200 ETF.
This was the very first ETF in Australia.
Yes, yeah, it was. Yes. Yeah, it was like 90s, wasn't it? Was it 90s or early 2000s?
Oh, look, it's not trivia time now.
Okay, we move past that.
2001, 27th of August, 2001.
What's interesting about this, Mitch, right? If you look at this ASX 200 ETF, and people can see this if you're watching or listening, this like plain Jane vanilla index ETF has a dividend yield of 3.6%, price earnings ratio of 18, and over the last, I think that's estimated growth rate in profits of 5%. So 5% profits, 3.5% dividend yield, and it's 18%. Now, if I switch to the other one, which is just the dividend focused one, the growth rate cut completely in half, 2.4%. The dividend yield, you've added 1.4%. So you've lost more in growth than you've gained in income. You've got lower valuations because you've tilted the portfolio to more mature businesses. Seesaw. The seesaw, you've tilted the seesaw. And overall, the seesaw is lower because you've given up growth in order to achieve income. But the income here in the very plain numbers, which Spider has provided for viewers of the website, great website, it's plain to see that you are seesawing too much. That's my assessment. Thank you.
That's my TED talk. So I think it comes back to, though, thinking about a portfolio in total return context. I think so many people sit here. I got that particular question from someone who had been a property investor all of their life, and they were realizing that their residential properties were not going to bring in the income that they required leading into retirement.
Yeah, no.
So the question was lobbed out: how do I get 5% income? And so I think in retirement, especially, having an eye on that total return, you can eat capital growth just as much as you can eat a dividend.
Yeah, we had Simon Russell, Behavioural Finance Australia founder, on the show a couple of years ago, and he said the biggest bias. Well, we all talk about loss aversion, blah 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 in this industry. Who cares? But the biggest bias that actual retirees have is they measure everything in dividends. You could just sell some of your growth. It's not like a property. You can't sell the bathroom or the whatever. You've heard that analogy, but you can sell it. An option for property investors, we did mention, if we bring this up again, Adrian, sorry mate, is the Charter Hall Long Whale read again. There's this whole thing on social media in particular at the moment, it's on YouTube, about people that are looking at property and they're like, well, I can't buy my residential property, so I'll buy a commercial property. That is an absolute. Is that
actually happening on TikTok?
I don't think it's just TikTok. I think this has been happening for the last few years. Everyone goes and buys these small warehouses or these office buildings. Absolute nightmare. It's like buying a hobby farm. All the good farms go to the actual farmers, and everyone else gets the unarable land. And with these things, you don't need to be like going premise to premise doing inspections. You can just buy the REIT, which has been around for a very long time, that has A+ property in it, and get your 6%. So to your person, I would say to them that you can achieve that goal. You just might not be able to do it in residential property unless you geared it up to the hilt, and I don't know. That's risky.
All right. Now, this is a quick plug to the community. Just before we came on to record this, someone's jumped on there, their very first post ever, so I'll forgive them for putting the entire question in the title section. But they say, hi, everyone, looking for an ETF to invest in that will give me monthly income. What are the best ones that you've been using? Let's talk about the monthly income paying ETFs out there. They're predominantly bond, credit, and cash ETFs. There's, I'm struggling to think of an equity ETF that does that. I can think of a couple of LICs like the Plato Income Maximizer, PL8. That does pay monthly. I can think of Qualitas.
Yes.
And QRI, that does pay monthly as well. That's essentially like a property ETF. It's lends to property developers.
Yep. Which scares the bejesus out of people when they hear that. But it's actually a really good fund for what it's worth. You can see. Can we bring that up, Adrian?
They'll probably email in correcting me on that though.
So you can see this here over time. Never mind that little blip. It's normally a flat line in the share price, and that's because the dividends are basically paid monthly, and it's kind of like regulator doesn't look at me when I say this. It's kind of like a bond fund in that as long as everyone pays, it's like someone's made a promise, you get repaid plus the interest throughout the period. It's actually, we looked at it before, but the problem that without the way we invest and how we have investors joining us to invest regularly, it's a bit hard because we don't know exactly, because of the way it's structured. Someone might join at like today and get a different price to someone tomorrow. We'd need to monitor the valuation, but it's a good thing, and it's backed by short duration bonds, short duration lending to property developers, property owners, those types of things. We actually had Andrew Schwartz, who's the founder of Qualitas, on the show years ago. Yeah, so you can go back and listen to that. That's monthly.
That is monthly as well.
MOKT, AAA, ISEC, the cash ETFs.
Those cash ETFs.
Enhanced cash, they pay monthly.
All right. So finally, Owen, I did see on your screen before you had a few specific ASX listed companies to bring up.
Yeah, sure. So I thought I hid them, but that's okay.
Did you? So if you didn't want to talk to them, we can...
No. As in, like, I was trying to keep them a bit of a mystery.
Oh, right. Well,
let me just bring this up here. Where did I put it? Here we go. Sorry, Adrian. Okay. Yes. So I've already mentioned Charter Hall Long Whale Red. Owns 500 properties. At the time of this recording, it hasn't been included in our models, but will be sooner or later. So you get the property exposure. It's not really a stock. It's a REIT, a real estate investment trust. So it owns properties. Those properties pay rental income. The rental income then flows through to the trust, which then is distributed to the investors on the stock exchange. It's not the type of thing that you get for a lot of growth. It's more the income skew. And we heard before, it's about 6% plus. So really compelling, particularly at a time when there's a lot of uncertainty in property, but there doesn't seem to be a lot of uncertainty in shares. So what I mean by that is, if you look at the average valuation of the shares in Australia, some things are pretty expensive. You look at commercial property and there seems to be a lot of uncertainty still. Like, people are worried, is it going to be a return to the office? You know, Prime Minister's saying this, President saying that, companies offering this. Like, it's a bit uncertain. So you can still get a bit of a premium there, which is quite good. My family favourite is Solpats. ASX SOL is the ticker symbol. People are probably sick to death of me talking about it. We've had the Milner family on the show a long time. You said 1903 before, Mitch?
Yes, 1903. They've got a fantastic page actually dedicated to their dividends. That's how focused on them they are. They
take it seriously. These things called dividends. But if we just bring up the chart real quick, Adrian, for people that are watching, you only get only 2.6%.
That's just the price chart, isn't it?
Yeah, this is just the price chart over time.
So add in the growing stream of dividends.
Yeah, and the investment portfolio underneath has grown really well. We've had Todd Barlow on the show last year. CEO, he's been there for a long time. Everyone's been there for a long time, to be honest. I think if you've been there 20 years, you've been there for...
You're still a newbie.
Yeah, you're still new. So great culture, great business, philosophically aligned to long-term investing, own really great assets like TPG Telecom. Another one that I'll call out, which doesn't offer a lot of franking, is Macquarie Group. 3.3% on the dividend yield charts. Recently made some sales. Has been sold off recently, given the Trump slump, as you put it. That's the first time I've heard that.
I'm not the one to coin that term.
Maybe you are here on the Australian Investors Podcast. So this one here, globally diverse financial services business, but increasingly focused on retail banking as opposed to investment banking. Still does that. Still excellent. Making some change.
My mortgage through them.
Yeah, I think Drew's banks with them. Saw some clients today. They bank with Macquarie. It's very, very impressive bank. It's got a really good wealth platform for financial advisors. Really just robust business, good leadership. And I mentioned before, I'm trying to remember, I think it's over 50 years of consecutive profits. I don't know if it's consecutive profit increases, but it's an impressive track record to say the least. So again, you're going to get earnings per share growth, you're going to get like profit growth, but you give a little bit up with the dividend yield today. So for long-term investors, not a bad one. I had a few mates right into the show. Shout out to Ryan Newman from the Motley Fool, who I thought he was trying to do me over with a bit of a dodgy stock pick on the old show, but he didn't. He came up with PWR Holdings.
You just got the ticker code wrong.
I got the ticker code wrong. I forgot. PWH is the ticker symbol. And this company does intercoolers and those types of things for the F1. Founder-led, although the founder had to step back recently for medical reasons. A really, really impressive company. One of the global leaders here in Australia at what it does, which is a great thing to say.
Basically, if you watch the Formula One, their cooling systems are in every single Formula One car.
Yep.
That's the easiest way to see what they do. But big defense contracts in the US, etc.
Yep. Finally, a company here we just got it on the Market Index website is Steadfast Group. SDF is the ticker symbol. Financial services, insurance, these types of things. We did have Luke Larrative on the show, The Dome, not too long ago. I think he was talking about SDF. But any business that makes money from basically not taking the legal obligation, which is what brokers do, thanks for that, Adrian, is worth researching. We don't own these stocks inside Rask Invest. We'll give an honourable mention to Wesfarmers, which is reasonable dividend yield. I'd take that over something like Westpac. Or did you say ANZ before?
Oh, it was in one of the trivia questions, yeah.
Yeah. What is ANZ? What would ANZ have to offer you in a dividend yield for you to get excited?
Well, I don't really get excited about the banks. But if I couldn't, I don't know. It's not. I hold.
What happens if I said it was 10% and it was going to be paid?
And it was going to be paid. I was going to say if it's 10%, I'm looking at a dividend trap.
But do you know for the next year it's going to pay?
In ANZ? Yeah, sure.
Yeah, it's 5.6 plus franking. Yeah. Okay. Good to know.
But they're the only, the trivia question was which two banks have returned their dividend to pre-COVID levels. CBA and ANZ are the only two ones to do it. So Westpac and NAB still below their pre-COVID levels.
NAB 4.7% dividend yield. Yikes. Share price still below COVID peaks. Anyway.
Owen, this has been our dividend pub trivia.
Mm-hmm.
Yeah. It's been good.
Yes. If you do want to see our full portfolio, I'll say you can go and head to the Rask website. It's just rask.com.au/raskinvest. And you can see what we own. So if you're worried about us not doing enough disclosures, you can see it all there. You can see what we own, the different models and so on and so forth. That's probably the shout out that I'd do if people are wanting to learn more, as well as all of the podcasts that we did mention throughout this episode.
Also jump onto the Rask community.
Yeah.
The community is really kicking off. There's just under 1,600 people on there now.
Yeah.
So questions every single day coming onto it, comments being posted. Everyone's friendly, even to us, which is great.
No, but it is great. And it's a really good source of feedback and intelligence. There's some really smart people in that community. I actually had someone on Twitter who goes by the name of Churgers reach out to me.
Yeah. Churgers he was a really early adopter in the community, and he popped back on just the other day, which was great to see him.
I will read out verbatim what he said to me 2 days ago on Twitter. Owen, I have taken a look just now at the community within Rask. My first post, which was during the inception of the discussion board in April 2024, it is incredibly impressive to see that so many people who first commented on one of my posts are still incredibly active within the community. Incredibly well done for that, managing such a strong retention. You must be doing something right. Well, it's not just Mitchell and I, but Churgers, but we do appreciate it. We've got some amazing members that jump on there. It's free to join, talk about ETFs, talk about funds, property, whatever. The podcast hosts are in there as well. So,
yep. And if you are getting into it, download the Circle app because it's run on Circle, the app. That's a fantastic way to keep up with everything. So, that's my shout out.
Cool.
Let's leave it there.
I like it, mate. Thanks, Mitch.
Cheers, Owen.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.